Well, hello, friends, and welcome to From Busy to Rich, a podcast that helps financial advisors grow their businesses beyond the products they sell and the assets they manage, to increase profitability and reclaim their time by providing strategies and insights that will not only change your life, but practice. Today, we're going to be talking about something I think that is near and dear to all of our hearts and just very timely given all the uncertainty that's going on in the markets right now. And it's March 2025. There's discussion around tariffs, geopolitical situations, potential inflation, and interest rates are high. So one of the things we really want to hone in right now is building this proactive approach and stance on how do we navigate client emotions. And Wes, I know we've got some foundational beliefs and philosophies and values in how we approach this. So I want you to talk a little bit more like what are the challenges I think that are inherent to, really any industry in navigating. If you deal with people, you deal with client emotions, right?
Yeah.
That's part of it. And then specifically, going on with what's going on for our financial advisors, even for us as a good reminder.
Yeah, absolutely. I mean, I love this topic. And we were earlier in the week at a conference and we spent a lot of time on a panel discussion talking about this very topic. And it's there's a great quote that I think really centers a lot of this by a guy named Samuel Johnson. And he said, we need to be reminded more than we need to be instructed. We need to be reminded more than we need to be instructed. And so when it comes to people that, if you're in the business of putting money into stock and bond mutual funds on behalf of other people, there's a lot of things that need to be instructed. And there's more than that, things that people need to be reminded of, because we are, the moment they leave that meeting with you, they will begin to narrow their focus to the things that they have to do day to day and forget a lot of the things that they agreed to and a lot of the things that they thought were a great idea in theory when you were initially meeting. And so what I think is helpful, if you find yourself frequently when markets are in a place of, well, I wouldn't even call it uncertainty, Justin, because I think markets are always uncertain in the short term. I mean, it is 100% of the time. It's perceived uncertainty when people perceive that, hey, markets are uncertain in the short term because they're being compressed, as they have been in the recent times here. If you're getting a lot of calls and people are like, oh my God, tariffs and whatever news network, or I didn't even call them news networks, whatever financial entertainment network they happen to listen to, however they're spinning the current thing. And they're going, oh my God, what should do? What do we do? Do we sell? Should we sell? Or hey, you're going to sell because I want you to. And we all know that there's not a lot of wisdom in that moment, in that, because nobody hits the tops and nobody hits the bottoms. But backing out of all that, I'd like to start the discussion around how do we help clients make better decisions and live with fewer regrets? Because what we have, Justin, as you know, is a very systematic process of both onboarding new clients, and that's really where we begin to instruct them on philosophies and ideas and how we operate in light of the fact that the market is going to move up and it is going to move down hundreds of times and in a variety of different levels. Big, small, it's going to, and I don't even like the words up and down. I just say it's going to expand and it's going to compress. Mostly it's going to expand over a long enough period of time. So in our process, as you guys know, if you've listened to our podcast for any length of time, we do holistic fee-based financial planning. So everybody we're meeting with, we have a first meeting where we're tell them the kind of work we do, who we work with, and really just begin to ask a lot of questions. And we've got whole podcasts on that. We teach classes on our process as well through Transform. And then we want to learn about what story they're in and what story that is unlived within them, so that we can understand what strategies that what areas of planning that we specialize in may be most relevant to their story. So we're starting somewhere different than a lot of folks. We spend a lot of time just trying to understand where are you now relative to the future that you're trying to create, not just 30 years from today when you want to make work optional, today and tomorrow and the next day. What does life look like? The story that you're living out, because we love the definition Carl Richards had many years ago. Meaningful financial planning is about the alignment of the use of capital with what you really care about. So Then we get to all our next meeting with them, which is expectation phase. And that's really where, in a lot of the story they're in about money, let's look at on paper where you are on the screen, where you are in your personal liquid and business assets. And then let me pull up the whiteboard and let's talk through all these areas of planning that relate to the story you're living out in your life. Because everything starts with the client story. You know, that Stephen Pressfield quote that says have two lives, have two lives, the life we live and the unlived life within us. What we're really doing when we do planning is you're helping people understand, okay, here's the life you're living now. And here's a potential unlived life within you that I think you want to go towards. So as an example, we say this all the time. Everybody wants to create a healthy income. Every single person. A healthy income is one that's larger than what's being consumed. And they've got some way that they're doing that. And usually the thing they're doing to create that, the work that they do or the business that they own and work in is an enormous part of their life. It's also a place where they can uniquely exercise their unique ability. And it's very highly connected to us as people to do good work. And even if work's hard, not every day is going to be paradise, right? And there's ups and downs just like in any area of your life. But they're working and they're making money and they're making more than they're consuming, and all this stuff happens to the money. You know, taxes happen to it, so we talk about that. And then they're spending money, they're giving money, and then they're saving money. And here's where this discussion ties into markets today, because they're saving money into what we call your family bank. And one of the things we talk about is your family bank is made up of everything you have that is considered liquid. And by liquid, our definition of that is anything with a phone call or a mouse click that can be immediately turned into a US dollar. Stocks, bonds, stock and bond mutual funds, cash, CDs, life insurance, cash values, crypto could fit in there. Anything like that, anything you don't have to like put on the market and put a for sale sign in the yard or put it, sell your business. You have to go to, put business brokers and things like that. These are immediately convertible to a US dollar. And here's the role of the family bank. The role of the family bank, and this is how we kind of condition our clients to see it, is it's really a couple things. One is it needs to support your unique ability. And if your unique ability is to run this business that you own, you should always use that to support you getting better at doing that thing. And that can be, hey, are we investing money, not just in liquidity to save it and defer it, but are we investing money also from the family bank into our own education, like strategic coach? You guys have heard us talk about that. If you're an advisor, Transform would be a great place for you to invest, to learn and get better at your trade and really elevate your unique ability. Hiring people, buying equipment, buying real estate, if that's connected to your unique ability. But what is your unique ability? Because it's going to be a big part of your life, and this puzzle piece should help fuel that at very specific, appropriate times.
I think that's so unique and such a good point. And I'm just going to be quick on this, that the sense of typical money management, it's focused on optimizing the money within whatever account you're managing. This is very different in the sense of, while that's part of it, it's optimizing the entire thing as a family bank to optimize the story of the life and objectives, right?
Yeah.
We're not just trying to generate a higher return within this account, but instead it's how do we navigate this from a bigger perspective to make you better at and increase your, again, profitability and quality of life holistically versus in the subset.
Yeah, and that's the deal. And that's a game most advisors that are traditional money managers, that's what they do. The client is the money. They're not looking at how does this money impact the rich life this person wants to live. And so many people, Justin, and this is going to be very contrary for a lot of the way people are trained and think, they would have been so much better off and further along in life if rather than just deferring all their money and over saving money into a 401k or something like that, they would have taken that same money and put it into them getting better at their unique ability. People understand this when it comes to college, and college is great, right? But it's mass, and everybody comes out of it with a degree, and people hopefully learn. They get smarter, some more than others, and they spend a bunch of money on it. Or if you're a parent and you've got kids, I've got 2 kids in college, a bunch of money goes there, right? And so I'm for that, but I'm also for being a lifelong learner, but also a lifelong developer of your unique ability. And there are things in every industry that you can do to not just, be great at the level of a college graduate, but be great at the level of a tenured corporate executive or 10-year business owner. And there's different jumps along the way. So you understanding that's a part of the family bank. It should strategically over time fund that. Now that doesn't mean you spend all your money. You still have to have, margin, and you still need to be putting money away. You can't spend everything on it. But the second objective of that family bank, because we want to increase the velocity of the family bank to fuel what's happening in that client's rich life. And so that's the one objective. The second objective is we want that family bank one day to be large enough to be able to produce a passive income to the client, to where if they're still choosing to work for money, it's because they want to, not because they have to have a healthy income. And so then it brings us to this. And this is, we're starting broad and we're going to get real narrow here. We have to say, okay, what is our family bank philosophy going to be? And our family bank philosophy is, where do we want to hold money and why? Because there's hundreds, if not thousands, of different product options. And then there's hundreds, if not thousands and thousands of different individual investment options. There's fixed options, variable. So here's what we do. We start, and if you imagine a funnel, we start at the top of the funnel and we want to get agreement on philosophy. Okay. And this is where we're first instructing them. And we'll have to go back and remind them of this a lot. But agreement on philosophy is that markets are, let's just use the S&P 500 index. And again, we would never put somebody solely in that for reasons I'll bring up in a second. Over time, yes, it goes up and down, but over any, 15, 20-year time span, it goes up pretty good, right? Pretty dramatically. And you can look at a lot of different stats. Some people say 8, depending on the time period you measure, is the average rate of return. Some people, if you take a different measurement, it's 6.23% is what it annually compounds. But that's an average, and it doesn't do it that way, right? It goes up 35% and down 25 and down up 30 and down 40. And then some years kind of flat and some years up 8. But over time, it is kind of like, I heard going up an escalator while doing a yo-yo. It's going to mostly go up over time. It's just, you'll have these peaks and troughs. And that's going to be, even if you're broadly diversified in all the different kind of, indexes or in a small cap, mid cap, large cap, international. Those things are all going to move. They're going to take turns at the top and they're going to move up and down. So all we want to do here with the client is say, hey, look, in light of the fact that markets move up and down all the time, in light of the fact interest rates change and there's, recessions, there's periods of great expansion, there's all these things, tariffs, and there's tax. Will taxes get extended? Will they change at all? Will we have a terrorist attack? Will there be another pandemic? Will there be a war? Will there be, you can will your be to death here, right? But in light of the fact there's all these things, what is our standard of care that we're going to agree to going to be on our family bank? Well, how are we going to do it? And so let's start here. We're going to say, look, every single thing we want you to think about is either going to be variable or it's going to be fixed. So if you were drawing that out for a client, you might say, hey, if you have personal liquid and business assets, this piece of the pie, and you could just have a third of that pie represent liquid assets. And then you draw a little dotted line down the middle of it to start in between the liquid piece of the pie. And you say, so you write a V up there in the top part of the piece of the liquid piece of the pie, and you write an F on the bottom piece of the liquid pie. And you say, so you have variable assets and you have fixed. Variable assets are this. The trade-in value is set by the market any given day. So there is no guarantee. One day it's going to be up, one day it's going to be down, mostly up if it's allocated correctly. Now your fixed, they have this quality, is that there's a guarantee involved, meaning it cannot go down due to market volatility. And usually some kind of guaranteed interest rate or dividend rate. So, most commonly people might think about a savings account because you put money in there. What's in there today is going to be in there tomorrow and a little bit more based on whatever the interest rates happen to be at the time. What the most powerful thing we can do first and foremost is agree on what should our variable to fixed ratio be. Because let's say that we decide based on where you're at in the whole picture of your life, and the amount of liquidity you have, let's say we wanted you to be 50-50, 50% variable, 50% fixed. and you got yourself there. Here's what's going to happen. And I'll usually draw like a little squiggly stock market graph line going up right in that piece of the variable portion of the pie chart. And I'll say variable markets are doing this, right? And what about when they do this? And I'll have it go, I'll just make the chart go down. I said, kind of like if you were meeting with a client today, kind of like in this year, we've had a kind of a rocky start to the year. We've had a little more down than we've had up in like the S&P 500 index. When that happens, because remember you're fixed, and I'll just draw a nice little, not quite flat line, but not a 45-degree angle line to represent that fixed kind of goes at about a 4 to 5% rate of return. If it's optimized, it's doing this. So when markets are compressed, and I don't say down, say compressed, because that's truly what's happening. Values are compressed, right? When markets are compressing, and value, you could say because trade-in value on these assets is temporarily selling at a discount from what it was prior. Think about how different language that is than any news networks uses, by the way. You ever turn the news network and go, hey, good news, markets are selling at a discount. Markets are temporarily compressed.
And let's be honest, they're not watching the news, it's TikTok, right?
Yeah. TikTok, although I'll tell you, some of those financial entertainment networks here's the deal, and we tell clients this all the time, none of them, they get money because you tune in and you stay tuned in. So you're never going to like tune in and they go, hey, everything's working out great. Come back next week, But so we'll get to that in a second. But this is like the base level of saying, hey, do you agree? There's variable assets, they move up and down, and but more up over time. There are fixed liquid assets, and they just go up, but at over a longer period of time at a lower rate of return. And when this happens, and I draw that line down in the stock market graph, when markets are selling at a discount, you would go, if you were 50-50 going into this year, you might find yourself, and let's say in a really good correction, maybe you're at a 30-70, because the value, the total liquid value of the trade-in value of all of your capital, it was affected because the variable portion is selling at a discount from what it was when the year started. And so now that represents 30% of your overall liquid value. And though your fixed didn't just leap up in value all of a sudden, it's just a steady eddy. It's just relative to the variable. It's now worth 70% of the overall liquidity that you have. When that happens, and I'll ask clients, when that happens, what do you think most people want to do? And every time they say the same thing, well, I'm guessing. It's never them, right? But they say, oh, I'm guessing most people are, it's like, hey, I want out. I want to sell. I said, yeah. And listen, that's just behavioral. It's human, because as humans, what do you get when you look at all you get when you log into your account right on the front page, or you get your statement, is you see what the current trade-in value of your portfolio is.
Right.
You don't know. You still own all the same assets that you owned before, supporting what that trade-in value is. It's just temporarily selling at a discount. It's page 1, and they don't turn to page 3 or 4, right? And they say, look at all the money I've lost. And I'll say it to them just like this. And I'll say, I don't know if you've ever felt that way. And usually people, if they've lived enough life and they've done this, they're like, oh, yeah, I have. I'll say, and here's the thing. It makes us do something that's really a bad thing for our long-term health of our financial future. It makes us go, I don't like it. Look at all the money we lost. Let's go ahead and stop the bleeding. They'll say things like that. And it's the only place in the world that people don't get excited when things are on sale. Because it's like if I was going to go buy a car, and the car I wanted that was selling for, let's say, $80,000, and then I go look at, and for me it'd be a truck, but I get $80,000 truck, and then I looked at it the next week, and the same truck was $40,000. I wouldn't go, oh my God, the value of that truck went down so bad. I'd go, no, I want that truck, and 40,000 sounds better than 80. And now the only deal with the stock market is they're an appreciating asset over time, right? Because you're owning good publicly traded companies that are producing value and revenue. So when I tell them that, they get it, and they kind of laugh, and I say, yeah, so here's what we do. Here's where what we would do is we would take enough money from your fixed and push it into the variable to get you back to your disciplined standard of care, which is 50-50. And again, this isn't market timing. This is math. right? That's all this is. It's not the difficulty. It's discipline is what it requires. It's not hard, but people don't do it because emotions get in the way. Um, and so and they'll be agreeing with you on this time. They're like, yeah, totally makes sense. And I say, now then it can do the opposite too. When it does come back, because 100% of the time, markets have always come back to a new high. The question is just how long and what's the ride like to get there. So my money's going in and buying things for pennies on the dollar. Then when that market expands, it doesn't have to get back to where it was before because you bought as things were coming down and you did it based off of that discipline. So when markets come back up, you're going to be way ahead because your dollar went in and bought your 50 shares instead of 2, depending on the value. And when markets are expanding, we're just going to scoop some profit off and push it down back into the fixed because you'll be opposite the other way. When markets expand really wildly, like they have over the last 2 years, and we've been having all these client conversations over the last 2 years, markets expand and you go from 50-50 to all of a sudden 70-30 variable to fixed. Well, we're just going to scoop that and put you back to 50-50. And now here's the thing. Emotionally, that logically, this makes sense, right? Nobody sits there and goes, I don't agree, but you really got to ground it in emotion. I said, I want you to think about it. I said, because here's what most people do is most people, again, even though they know this information, because in a moment of clarity, this makes sense. When you and I are sitting here and we're drawing pictures on the paper and we're using percentages, it makes sense. But I want you to feel this for a second. And I'd say something like this. I'd say let's say you have $1 million in your variable. And let's say the market goes down by 20%. It compresses by 20%, selling at a 20% discount from its high. And that sounds really good, doesn't it? And because now if you had fixed money and you can push it in, man, think about the discount you're getting. And you were happy with it when it was higher, right? And it's going to go higher again. And we all kind of know that. So when that's there, but people aren't happy. Because if you think about it, what you see on paper is you had $1 million last week. This week you have $800,000 in your variable assets, and losing $200,000 feels way different on $1 million than just saying, "Oh, it's down 20%." But I need you to, because emotionally you're going to look at it and go, "Oh my God, look at all the money we lost." I need you to tell yourself a better story because the story you're suffering unnecessarily for the story you're telling yourself. Even if you don't sell and you tell yourself that story, you're suffering right now unnecessarily. Because in context, here's the thing. Markets always move to a new high. And so now financial news networks or entertainment networks, they're going to say it's never going to be good again. This time it's different. Here's all the reasons why. And 100% of the time, it's been good again. It wasn't different. Those were reasons maybe why, but why it moved down, but it didn't matter. It moved back up because you can bet on something that's never happened or something that's happened 100% of the time. And I would say it's pretty skewed which line you should choose. So if you really tease this out, Justin, with the client in the early days of seeing how ridiculous it is to make these rash decisions, it helps stick a little better. Even in the initial education session. And then we talk about where to allocate it and all those kind of things. But really it's this variable fixed discussion that we build the foundation of the family bank by saying, this is your standard of care. When markets move up, we're going to take profit. When markets compress, we're going to take territory. And clients love that word, territory. We're taking some territory now. So thoughts on any of that before we keep going?
Yeah, no, I love it. We even talk about this as, kind of becomes an attack asset, especially for clients that are of the opposite perspective, that like, well, I don't want to put any money in fixed. It's earning less rate. I can get more out of the market stuff. This philosophy as a whole really builds its unique energy and response out of clients in times like this.
Yes.
We can get a baseline foundational agreement. They agree to move forward. This philosophy, they understand and see the value of it, regardless of what that discipline is. In times like this, it makes the conversation so easy because then they say, I get it now. Not that they're happy that markets are compressed and that their variable account's down, because they call about it.
Sure.
But when we talk about it, we say, this is exactly why we have this asset. This is the type of opportunity that it creates for us. Because if you were just up here, you wouldn't be able to do this. We wouldn't be able to take advantage of it. we've got this capability. And then when it switches back and it comes back, even just baseline, because we acquired those additional assets at this discounted price, now we get to reap some of the reward and profit for managing our emotions during that cycle.
Yes.
I just love that it changes the dynamic and gives you a baseline. And then the last thing I want to talk about is this is not a new conversation. This comes up every year and it has to be recycled. And so just one other tool, something I want you to talk about is what we've implemented more recently of how can we regain some time for ourselves and just help keep this in front of clients with what we're doing.
Yeah. So listen, this is such a powerful way. This conversation we have, including when we call it the family bank conversation, about variable to fixed. And then even further, if you want to go a layer deeper into why we use whole life as the fixed asset, because gross tax-free, creditor protected. If it's structured right at about a 4 to 5% compound tax-free rate of return, don't have to be age 59 and a half to get to the money, and it has no market volatility. There is no other asset long-term that performs like that. And so we've got a whole discussions around all that, but for our clients, just understanding this is the fixed component. And we like it because, as Justin, you brought up beautifully, is it's a tactical asset. When the markets go down, we're going to take territory by using that money, not because we just liked getting 4 to 5%, because we do like getting 5% on money that can't go down in value. And we're going to use that to go get way more money on a return on our money when markets are compressed. Or if you're a business owner, you can push that out into real estate or business assets or hiring people. It's tactical. So what we do, clearly we have this conversation up front. Every year we have it with them when we're sitting with them in our mid years. But one of the things we've done that is so useful, because especially when sometimes people forget, why do we have the insurance and why do we do that, is we will do a variable fixed conversation on the family bank. And then as just an educational tool, say, hey, this is a reminder. Here's kind of how we think about this and how we operate. Very short Loom video, right? And you can use whatever screen recording you want. It's just general in nature. You just say, hey, this is the way we think about liquidity, variable fixed. And what we do when markets go down, when they go up, we want to make sure you have enough fixed to where you don't have to sell variable assets when they're down, so that if you need that for your business, that's why one person's ratio may look different than another's based on the liquidity they have and the needs they have that aligns with the rest of their life. But you do this short Loom that just, it brings them back up to where they can see the whole field. Because the problem is they're just seeing one little spot on the field that market's bad, it's down, and people are reinforcing that for them. When you can just, hey, let's go back up to the big picture here. Let's talk about how the whole picture fits together, because you're thinking of this one thing, which we said was going to do this at some point. And by the way, it's going to do it again and again and again. When it does, that's why we have this other part of the field. That's why we have these other puzzle pieces to push in. So you record yourself doing that. Then you take your, if you wanted to, even go into, hey, here's why we use life insurance for this. Here's kind of how it works. It grows like this. It has all these benefits. Because people need to be reminded more than they need to be instructed. So you got to ask yourself a couple questions, I think, Justin. And I like your comments on Loom and all these other things. But I think that if there's a dominant theme throughout this discussion, when are they getting instructed? Because I've done this myself. People say, hey, I got this money, want it invested. Before we were doing financial, like holistic fee-based financial planning and getting the big picture first, sharing philosophies. Are you just putting money in the portfolio and not really they're filling out a risk tolerance questionnaire, which means nothing to most of them, by the way? Or are you saying, hey, look, this is what's going to happen? Are you spending time having that variable fixed conversation? And then when markets are down, and then every year, even when markets are going up, they need to be reminded. And you need to take some profit, because if you didn't do that over the last couple of years, they loved you. They loved you until like 4 weeks ago, right? And then they started not loving. And if people who don't have any fixed blended into their portfolio, they don't have anything to do right now. It's like, hold on. I hope you don't need money for anything. Maybe you could benefit them by going and getting a securities backed line of credit. then they're not going to like that it's costing them, 8% or 7% or whatever it is right now. Although we're for those. I'm not saying don't get them. I'm just letting you know, having a true fixed asset that you can go take territory with is empowering and it's profitable, super profitable for the client. So when are they getting instructed initially? And then what are your systematic ways and systematic tools you're using them to remind them? Because remind them is what you're going to do for the rest of their lives in this. Justin, your thoughts?
No, I think I just end it there. Really, it just landing back on the point of you start with a foundation of philosophy, and then you just continue to remind it and build into your process a way of being proactive versus reactive. You're having these conversations ahead of time so that when these things come up, when opportunities present themselves like this one, that they're calling you excited the other way. Like, hey, markets are compressed within real estate.
Yes.
I'm going to use this to go, I found this property that's selling at this discount that I've been looking at. Can I go after it? Can I go buy that truck for 40 grand that's on sale right now versus 80,000?
Yeah.
And it just empowers the conversation. And we'd love to spend more time on this. I want to land here. I know we've got some short time today, but highly encourage you, go check out the website. We have more talks on this specific topic. Go check that out. And we'd love to have you in the Transform, where we really deep dive into the learning series on all of these points and even the subcomponents within those frameworks and how we navigate that conversation. So you too could build out your own videos and things like that to help increase profitability and quality of life for yourself and your clients, and also to take back more of your time. So hope you enjoyed it, and we'll see you next time.
I've talked too much already, so I'm going to check in with you guys and see what anybody's got questions or things on this topic that we want to talk about.